markets spend most of the time going up. The thing you have to overcome is the reticence to buy anything. There have been lots of opportunities along the way. And the reality is that there are always lots of opportunities in the market. You are not the first buyer. Most people buy at the top. It requires an increasingly large volume of money to sustain these exceptionally high prices. When you have these incredible movements, you can make a lot of money in a very short period of time.
If you're new to investing, what stock to buy or what investment to buy, if it's not a stock, seems like the most principled decision or question you have to ask yourself. But there's a step behind that, which is, how do I decide what stock to buy? How do I decide what investment to buy? This is not an easy question to answer, especially with all the information, many of it biased or at least very passionate, coming at us in the markets today. So my guest today is the closest thing to an all-terrain vehicle in the investing world. His name is Eoin Treacy. He's a global strategist at Fuller Treacy Money, spelled Treacy. It's an Irish spelling. You can find that on Substack. And he can talk about equities, currencies, commodities, crypto, basically anything. So today we're going to dive into not just some specific questions, which I'm going to ask him, but more like, how does a new investor decide what investment style is right for him or her? So if that's you, please watch. Eoin, first, welcome.
It's a pleasure. Thank you.
So Eoin, how would you describe your investing style? I mean, I describe you as an all-terrain vehicle, but how would you describe yourself?
Well, I consider myself to be a risk taker, but then also highly conservative. So I'm not going to fit into an easy bracket for anybody who's giving me a survey to fill out, because I have trained myself over years to use leverage, and mostly in the futures market. But then in my investments, I tend to be very conservative, because that's something that I'm going to hold, I intend to hold for several years at a time. So then I have a bifurcation in what I'm willing to do. I have capital that I'm willing to lose all of, but then I have capital I don't want to lose any of. And I kind of separate that up into two different investment styles from my own perspective for myself.
So right off the bat, my read on that is hard edges, to use a term from David Allen, who wrote this book, Getting Things Done, which I'm a big fan of. Hard edges. In other words, you've got these healthy mental buckets, a psychologist might say. This is your play money. This is your money that you can't take much of a capital loss in. This is some money somewhere in the middle. Is that accurate?
Yeah, absolutely. And I'll give you an example of that. I mean, I'm more than happy to trade in Bitcoin. I'm happy to trade in gold, or I'm happy to trade oil futures or natural gas, or just buy and sell long and short stock market futures. But at the same time, then I'm going to have bond funds, equity funds, ETFs in my buy and hold bucket. And they're completely different. Often they don't even perform in line with one another.
And so if somebody is watching this, you're talking about futures, you're talking about a lot of different things that each of them requires a fair bit of technical knowledge. Can you just rewind the tape a little bit and give a little background on who is Eoin Treacy the man, besides just global strategist at Fuller Treacy Money? Like, what's your background? What sorts of things have you done in your investing career? Like, why should we listen to you?
Well, I guess first is I started off with a philosophy degree, so I did not come into the markets with a finance background. Then I've really figured that I needed an education. So I took a job selling Bloomberg terminals in Belgium and Luxembourg back in the late 1990s and early 2000s. And I did that for a few years. And that's where I got my education. I really learned how to look at the markets, talk to people that are in the markets every day in every different aspect of the business, and find out what they do for their living and how do they approach markets. That gave me a lot of inside knowledge of just how do people do their job. Then I met David Fuller. We built Fuller Treacy Money together, and he died a few years ago, but he was one of the originators of behavioral analysis to markets. So I learned a lot about that, and then I wrote a book on it about a decade ago. And in between, I trained myself how to take risk. how to address my own proclivities. And I think this, is something that everybody has to learn as they first come into the market. You don't know what your risk tolerance is until you take risk. People can ask you, what kind of risks do you take? And for some people, taking a risk is going 5 miles above the speed limit. Some people, a risk is putting something in the oven and not setting a timer. For others, it's going to be putting down a huge bet and hoping it comes off. You might think of yourself as not risk tolerant, and then you end up taking risks that you don't even understand. So you need to first start off small. I think that is by far the biggest step for everybody who's never invested before. Do not put your entire bucket into one investment. I think that's the most important thing. First, you need to put some money into your investments, see how it performs and how it makes you feel. It's only you can tell yourself how you feel. Nobody can tell you how you should feel. And if you make money, you're going to feel great. If you lose money, you're not going to feel great. But it's going to influence how you make the next decision. And once you know that about yourself, well, then you can start putting together an investment plan. You can talk about how much money you want to put at risk. But you have to know what it feels like to lose money. That is, I think, the only way that you can really address what your risk attitude is.
I think that is excellent advice. And by the way, interesting side effect of a Bloomberg job is you are interacting with professional investors. That's really a very good way to kind of explore the market and see who's doing what. But back to what you said, I think it's fantastic about behavioral finance. In a way, all investing is, in theory, a type of behavioral finance, right? Because investing is a social science, I'd argue, not the mathematical science that it masquerades as on the surface level. You're always trying to sort of outsmart the crowd, outsmart the market, and getting a handle on your own emotions, your own abilities, the unknown unknowns that start to become at least known unknowns as you poke around a little bit more. It's really more about mastering yourself, I guess, what I'm getting at, rather than mastering the market, if that makes sense.
Well, I think there are so many different ways of participating in the market, and then of course you have to also be of a mind that your actions are going to be influenced by how other people are doing in your specific friend group or your community. Because if people are telling you they're making a ton of money in cryptocurrencies or they're making a ton of money in Nvidia, it doesn't matter whether you own it or not. You're going to want to own it. You're going to want to make as much money as they do. And that is going to lead you down to either put too much money at risk, or that you are then only going to be looking at a certain portion of the market. So that is a behavioral aspect to how people engage with the market. But then, of course, you have to also start to think about, this is something that's really been at the back of my mind, is that we've had ETFs meet a massive proliferation in the market over the last 20 years. I remember when the first ETF was launched, and it was a big deal, and nobody thought it was going to be as big a deal as it has become. But the most important thing is that market cap weighted indices are predominant, and then ETFs invest in those indices. So what it means is that the largest companies are most rewarded by funds flowing into ETFs, which makes ETFs an implicit momentum strategy. So what you have to understand is, as soon as you are buying into a market cap weighted index, you are buying a momentum strategy. If you don't know what momentum is, what that means is that you're betting on the companies that are going up the fastest, continuing to go up the fastest.
Well, like Nvidia or the big tech
Nvidia.
companies. Yeah.
So, and of course, then what we have is that the fastest one goes up faster. So we started off with the Fangman companies. There was 8 of them. Then we had the Magnificent 7. Now we have the Magnificent 3. And that concentration of attention is something that we need to be aware of, that there's been a huge focus of attention into a very small number of shares. Now, that doesn't mean that they're going to continue to be the best performers, but it's certainly where all the media is. And if you're in the market to make money over the long term, well, then buying the flavor of the month is something that will work in the short term, but probably in the long term, you need to diversify your perspective on the market and to think not about what is the current big news story, but perhaps what will be the next big news story.
And isn't that one of the hardest things to do, Owen? I mean, taking your example, Nvidia, the 7 or 8 stocks, Feynman, that's been all the rage the past, year and a half, 2 years, whatever. But historically, equal weight S&P outperforms cap weight S&P. It has not at all in the past year and a half. So if I'm looking at that as an investor, especially if I'm new, if I'm 25, 26 years old, the lessons I'm going to learn by looking at the recent history are quite different from the lessons that a long-term study of the market would tell me. And so I have to have this like strange faith in the invisible to say, you know what, even though all my friends, even though all the stuff I'm seeing in the media is showing Nvidia and just piling into, maybe Kathy Wood stuff a couple of years ago, ARK funds, that's making everybody money now. Historically, that's actually a bad bet. I'm going to just like break with the crowd. Isn't that almost impossible to do if you're a new investor?
I think if you're a new investor, it's practically impossible to do. So what you do in that kind of scenario is you're aware that you are not the first buyer. You also have to be aware that most people buy at the top. And the reason that most people buy at the top is because it requires an increasingly large volume of money to sustain these exceptionally high prices. And that means that it is pulling in new investors constantly. So most people will buy at the top. So you know that. Then when you have these incredible movements, you can make a lot of money in a very short period of time. So now you have two bits of information. You know it won't last forever, but you know you can make a lot of money. Well, then you just don't put all your money into it. You put some in. Enjoy the ride while it lasts. But then also be aware that you need to have other things in your portfolio to give you some stability, because it's not going to always last. And when it stops lasting, you need to have other things that are going to compensate you for when the hangover comes, because the hangover will come.
So going back to your mental buckets idea from earlier, and by the way, to your point, I think in 2021, if I'm remembering correctly, more money went into U.S. markets than in the previous 19 years combined, something like that. Talk about buying at the top, right?
Oh,
Very
sure.
true. So you would make it not so binary. It sounds like you'd say, okay, we are in a big momentum trend. Let's pretend it's 2020. Stocks are going way up. Cryptos, everything's going way up. Maybe I don't want to miss that entirely. I mean, I could be, a dyed-in-the-wool value curmudgeon and just sit that out. But you'd say no. You'd say no. At least with your money, you'd allocate some money towards playing that trend. But then part of your brain would say, you know what? But this party's not going to last forever. Trees don't grow to the sky. I'm going to keep some other money in a safe bucket. Is that true?
It is true, because you also have to remember, and I think this is something that is one of the most important things to realize, is that markets spend most of the time going up. And the thing you have to overcome is the reticence to buy anything. If you're new to the market, it means that you haven't been buying the last 5 years or the last 6 years. And there have been lots of opportunities along the way. And the reality is that there are always lots of opportunities in the market. So you have to condition yourself to always be a buyer. Now, there will be times when you'll want to buy more or when you want to buy less. But those times are going to be influenced by performance. Whereas there are going to be bear markets along the way. And bear markets create value. And you'll have an opportunity to buy more at the bottoms or close to the bottoms and during recovery phases. Then you might, at the present moment, you'll have better value. But the thing you do not want to fall into is the tendency to think, well, just now is not quite the right moment.
Mm-hmm.
Because then what happens is people don't buy at all. And they don't buy during the bull market, and they definitely don't buy during the bear market. And then they are afraid that the bear market will continue, so then they don't get into the recovery. So you do need to be invested. You need to have at least some of your money in the market so that you are now a buyer, because overcoming that, I think it's a very dangerous mental block in just refusing to buy and thinking that you know better. That is perhaps the biggest hurdle to overcome for any investor.
There have been many good stocks that I almost bought, but I thought, it was just a little bit expensive. I'll just wait until it gets cheaper, and then it never got cheaper. So I agree with your lesson there. Let me ask you about this. Market generally goes up. I think it's 71% of the time or 73% of the time, depending on whose numbers you're looking at. On the other hand, this guy, Professor Scott Galloway, has been saying recently that we've had, before the last couple of years of relatively higher interest rates, we had a 13.5 year period or whatever of super low rates that enriched people who already were owners of stocks and already owners of property. But now these young people getting out of college and opening accounts, they don't have the same opportunities. They're forced to buy at these sky high valuations, and their investing future is just less pretty. What do you think about that?
Well, I think if you're coming out of college, you don't have any money. So, how much stock are you really buying? The reality is that you come out of your education and you're making a lower salary. And then what people don't understand when they're 22 is that your income is going to multiply as you get older. You're going to have more experience. You're going to be a more valuable employee. You're going to start your own business. You're going to have opportunities. And just like you have opportunities in your life and you have ability to multiply your income, well, you're going to have the same opportunities in your investment portfolio. There will be big buying opportunities. There will be bear markets, but you have to buy them. You can't just say, oh, yes, that was an opportunity, and now it's at a new all-time high. I didn't buy that. You're not going to make any money doing that. So that's, I think, the most important thing. When you talk to people that are saying, well, yes, housing is expensive. It is. There's no question of that. Are the opportunities available to young people more difficult today than they were in the past? Yes. They need to earn more money to be able to get on the housing ladder. They need more money to be able to pay back their debts. That is absolutely true. And I think it is a societal problem that something will have to be done about it. That has absolutely no bearing on how well investments are going to perform.
In a way, at least I tend to think we're it's not so much the haves and the have. Well, still will always be haves and have-nots, but those who participate in compounding and those who don't. There's going to be a greater and greater bifurcation over time if the markets continue like they have. In other words, if you are that young person, you don't have a ton of money. Guess what? Still, you want to get into stocks, or still you want to get into investments because there's a big difference in your life trajectory compared to someone who doesn't, and perhaps bigger and bigger as the markets mature further. And maybe I'm wrong, but that's tended to be my idea. Let me ask you, Eoin, though, about Nvidia, because a lot of people are probably looking at this stock. It's just the other day crossed first Apple and then Microsoft to be the largest stock in the world, largest company by market cap, not by revenue per se or employees. I don't know what the largest among those are, but largest by market cap. It's easy to look at a trend like AI and say, man, this thing is hot. It seems like it's going to be big in the future. I should buy. What's wrong with that thinking, if that's my only thinking?
Well, I think AI is going to be a big thing in the future. And I do wonder, are we going to end up paying for it? There's a lot of business models that are coming out, and I don't think we have a very clear idea on what the business model is going to be. Because I remember when the internet came out and we were paying for the internet and you paid for your AOL and it came on a disc, and then you got a free model. And I suspect that AI is going to go the free model. I think eventually the way that it's going to develop will be through a free model. But in return for that, we will be sharing a lot more of our data. Because that is what we're doing right now with Google. We share some of our data and in return we get services. Now, that is going to require massive computing power. But now we also have what's happening with Apple. And Apple is saying, well, we want to do a lot of the compute on the phone. And then for other bigger topics, we're going to have a cloud. Well, all of the chips are going to be Apple chips. They're not going to be Nvidia chips. And then the biggest customers of Nvidia are Microsoft and Facebook. So then Microsoft is developing its own chips, and Facebook has really seeded the entire artificial intelligence ecosystem by sharing all of their data for free. So, but they can also develop their own chips. So what Nvidia is trying to do is create an ecosystem that they're going to provide the software that will allow the chips to talk to one another. Now, that is a valuable piece of infrastructure, but I don't think it's something that is enough of a wall around their entire business to say that they're going to have a monopoly forever. But certainly they've done enormously well from the drive to really sell shovels in a mining market. And I think that's basically what Nvidia has done. They've done it enormously successfully. The share is going up very quickly. And I think now what we're starting to see, and this is something that I think is very important, we're starting to see now competition for the biggest bull. And this is something I talk about in the seminars that I teach, is something that you see in major bull markets is somebody wants to be the biggest bull. How do you make the most money? You become the biggest bull in the bull market. And Nvidia's market cap is about 3.3 trillion. And just yesterday, we had someone saying, I think by the end of the year, and we're in June right now, so 6 months from now, the market cap is going to be 5 trillion. Now, when you start to throw trillions around like candy, then you got to think that we are in a rather interesting environment. And I think that we are definitely in a mania stage for Nvidia, that the volume of cash that is going into the share is extraordinary. And when it stops, well, these kinds of massive accelerations don't correct sideways. And it's trading on a price to sales ratio of like 40. And what that means, just in very basic terms, is if they stopped spending money and they only put their revenue against their sales, then in order to earn back the market cap, it would take 40 years.
And this is not price to earning. This is price to sales. If some, earnings or profit. This is just price, which is not even a great metric because, it doesn't tell you much about the business, right? But, for this kind of a company, so it's really extremely, extremely richly valued.
Yeah.
Yeah. I mean, it's hard to imagine. I mean, they would take a long, 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 long time to earn into that valuation in any normal world scenario that a reasonable person could predict. And I bet a lot of the people, the money driving Nvidia up, has not mapped that fact that they're piling in because other people are piling in, and they're going to pile on top of that. At least that's how human nature has worked in the past in markets.
Yeah, absolutely. It's a mania. It'll keep going up until it stops.
Okay, so if I'm new to investing and I'm hearing Eoin Treacy for the first time, it sounds like I might sidestep Nvidia, at least for now. It sounds like I might look for an ETF. Do you have any strong preference on a market cap weighted ETF, which, as you said, is implicitly a bit of a momentum play, or an equal weight ETF? Any strong preference on what type of ETF somebody new might want to look into, or what kind of couple of ETFs?
I think I would first look at an equal weighted ETF because if I'm not going to buy Nvidia, then I am obviously not that interested in the complete concentration. So equal weight will certainly do better. But I also have to bear in mind that interest rates have gone up a lot. I mean, really a lot. And they've been high now for a long time. And we're starting to see that the consumer is under a little bit of pressure. And people are still worried about inflation. I mean, it's costing now nearly $100 to go to the cinema for a family of four. And, the cost of eating out is rather high. So we've had interest rates going up for a long time. And I think consumers are starting to feel the pinch. And I think then that we will eventually start to see interest rates coming back down. And bonds are real cheap right now. So I think that one of the real value opportunities right now is just the longer bond ETF, TLT. I think that there is clear potential that is going to do really rather well in an environment where interest rates start to come back down. And I think that is so unloved that it is certainly something that would do better. And of course, if we do see some momentum coming out of the high market caps, well, then that's going to create fears about an economic slowdown. And that's the time when bonds really do well. I would also start to think about some of the gold miners. And they have really started to uh, pick up with gold breaking out to new highs, but they're not expensive. So I would certainly look at that. And I think that China is really cheap right now. And I'm not a big investor in China, but a trader from a trader's perspective for a sort of a 1 to 3 year trade, then China's stocks are really cheap right now. And I think that they're going to have to spend some money to rescue their property market. We certainly had a problem in our property market about 15 years ago, and we spent a ton of money to try and fix it. And I think that China has exactly the same kind of problem today, and they're not going to be able to avoid spending money on it. And we saw what that did to our stock market, and I think that's a good trade for the next couple of years.
Well, first of all, someone who owns TLT, I bought it, I don't know, 6 months ago, 8 months ago, based kind of on your thesis. My fingers are crossed as well. And I like to think great minds think alike on that. We'll see what happens with that. On China, let me ask you a question, Eoin, that a former colleague of ours, Charlie Morris, was mentioning that May was the first month in a long time the PBOC, the People's Bank of China, did not buy any more gold. Do you think that's any kind of a warning sign? I mean, China had been accumulating quite a lot of gold. I think it's the sixth largest gold encompasser or gold holder in the world. The U.S. is number one by far, but China has been growing its gold position until now. Is that just a blip, or is that something we should read more into?
Well, I think there's a couple of things to think about there. The first is that this is not the first time that the Chinese government has stopped buying gold. And there have been several times over the last decade. Now, what they did on several occasions until about 2015 is they would just announce that they've been buying gold and that they've stopped. And then you would see that their reserves would just step higher.
Mm-hmm.
Well, then around 2014, they started reporting that they were buying gold. Now, that change was more about telling people that they want to own something other than dollars. And then they went through several periods of time where they accumulated gold and stopped, and then accumulated gold and stopped. And they've been accumulating gold for the last probably 18 months, and now they've stopped. Now, that really doesn't tell us anything about whether they're going to start again. But I think the more important point is that if you look historically at the correlation between gold and Chinese sovereign purchases, there isn't one.
Mm-hmm.
So
Mm-hmm.
they and I guess this is also makes sense. They're trying to buy without moving the market, and I think they probably haven't been very successful recently, so they've stopped buying. Now, I think it's more important that retail investors in China have been accumulating gold inside ETFs, so that is not Chinese buying. But then it's also worth considering that China's sovereign might be the sixth largest holder, but China is the largest producer of gold. So all that gold stays inside the country. They don't export it.
Got it. So switching back to U.S. shores, if I'm a retail investor, one of the things that I've seen a lot of in the financial media has been this recession is coming. I'm so sick of it because we never had a recession, right? At least in the past several years. And it was since COVID, and it was the recession that's been about to come, but has never really happened. I think people love to beat up on the Fed, and they've been beating. I mean, Jerome Powell was, he messed up, let's say, in creating too much inflation. And we wanted it, and we sure got it. We got a lot more than we expected. I think he's done a pretty good job, and your view may differ about engineering this soft landing. However, I was watching today this Peter Zeihan or something, some geopolitical strategist. He's making this selfie video on the beach talking about how it finally
we reached the end of the world if it's that guy.
Yeah, it's in the world. Everything's in the world. But the U.S. economy is being driven more now by government spending than private sector spending. And that is historically a danger sign, both in the U.S. and in other, in Zimbabwe and Venezuela, these kind of small countries that have blown themselves up. Therefore, we may be at more of a risk of recession. How much stock do you put into that?
Okay, well, the first thing is that we can look at what happened in other places. So Europe also spent a ton of money, and they've pretty much engineered a very mild recession, soft landing. And the UK has also engineered what looks like a soft landing. So it's not impossible, but there is a big difference there between what they're doing and what we're doing, because we are spending a ton of money. And there is huge deficits. And we have an election this year, and neither party is talking about shrinking those deficits. If anything, they're both competing with one another to say how much more money they're going to spend.
And Owen, let me just jump in. If somebody's watching this, by spending a ton of money, I think U.S. tax receipts are something like 4.7 trillion a year, but U.S. expenditures are like 6.2, 6.3 trillion. So that difference has to be financed by debt. Is that what you're talking about?
Yes. So
yeah. Okay.
But it's not just debt. It's that they're actually being quite successful in selling bonds. But the bigger problem is that when you're running a deficit of that size, what do you do when you run into an economic problem? Because what we now have are pro-cyclical policies. And a lot of people talk about the presidential cycle in the markets, and it's a 4-year cycle. And historically, what would have happened was in the third and fourth years, you would have some priming of the pump and some additional spending. And we are in the fourth year of the presidential cycle, so this is quite normal. It was usually in the first year of the cycle that you would have some reduction in spending, and they would really try to clear out the stables and really try and get the national finances back on a firm footing. And that pretty much ended when President Trump won in 2016, because the Trump tax cuts came in 2017. It was the first year of the cycle. And since then, we haven't had any kind of fiscal consolidation. So we're heading on to nearly 7 and a bit years now, where there has been just spending and spending and spending, and the national debt is accelerating higher. And if we do have a recession, and I think that we're in a different kind of cycle now because of this incredible amount of government spending, and the normal cyclical signals are not working, or at least they're working with a really substantial lag.
Like a yield curve signal, you mean?
Like a yield curve signal, like the leading indicators, like the jump in yields that we've had.
And the government spending is overpowering all this, basically.
All of that, yes. So what happens when we do slow down? Are they going to spend even more? Because if they do that and we don't have the higher interest rates, well, then the dollar is going to go down. And if the dollar goes down, then that's going to create inflation, because all of those commodity prices will go up. So that is, and we're starting to see just that alone with oil prices are steadier again. And now we're seeing gold and the precious metals doing better. And copper prices made a new all-time high only 2 months ago. So some of that is pricing in the potential that there is going to be an issue with the dollar if they don't get the spending under control.
Got it. And how, I think last time we talked, Owen, you were maybe about a 6 in terms of, on a 1 through 10 scale, your feelings about the U.S. economy, a 5 or 6. Is that about where you're at now?
I'm kind of more, I'd say a little bit more concerned now than the last time. I think that we are seeing just some additional evidence that the consumer is starting to slow down a bit. So I think I'd be a little bit more cautious than last time, but we're still in a bull market environment. Stocks are still going up, and I have to give the benefit of the doubt to the upside as long as the stock market is rising.
Ride the wave, right? Don't fight the government. So going back to what we talked about at the beginning, if I'm the new investor, I get into my equal weight ETFs, I avoid Nvidia. Can you give me one either company, sector, investment that I should be maybe taking a special look at, and besides TLT, we talked about that, and then something besides Nvidia that you might do well to avoid, or investor might do well to avoid, I should say?
I think if I was going to buy just a share right now, I would look at some of those Apple suppliers, because let's say Apple does come up with an AI product in September, and thing that doesn't seem to be discussed all that often is that there's a replacement cycle in Apple, and everybody's battery only lasts about 1,000 charges. So everybody buys a new phone about every between 3 and 3.5 years. And the last time a lot of people bought phones was in 2020, 2021. So we're kind of there. And people just want an excuse to go out and buy a new phone. And if it's an AI phone or there's a new Apple AI product, then I think that
All
some
the
of
better.
those
Yeah.
companies are going to do kind of well. And I think there is a basket of those types of companies like Acore Technologies or Qualcomm or Qorvo. Those are all those Apple suppliers. Or you just buy Apple itself, because if they can sell a whole ton of new phones, then that's going to be good for their share. Then I think if I were to avoid something and I just don't want to own it, well, I really don't want to get into some of the work from home or the kind of live at home, work at home champions. I think that there are several of those companies that are going to go bust. I think the trend is going to be back towards working in an office for the vast majority of people. And I think that Peloton is probably going to go bust. I think that Zoom is going to have a hard time making money. We're not even recording this on Zoom. So I think these are, I think, some of the things that I would just avoid. I think that there's just not going to be the kind of wherewithal for them to even survive.
Eoin Treacy, you are insightful and well-rounded as always. Your insights are much appreciated. Thank you so much for this. And thank you to you guys, as always, too, for watching us at home.
It's always a pleasure.